Right then, good afternoon everyone, as we are at the end of another week of trading. We'll look back at the week just past where the story has been equity index downside, which we'll get onto some charts in a minute and we'll have a look. Now across Monday and Tuesday there was low levels of volume, certainly across the US anyways, with with Independence Day in the US, obviously 4th of July being on Tuesday. So we start the week on Monday. You'd have to imagine a lot of people will have taken Monday off as well to get themselves a long weekend in the United States. So low levels of liquidity on Monday, low levels of liquidity, and some markets closed on Tuesday as well. So really Monday was kind of Wednesday this week for a lot of Americans. But since the back end of the week, or as we got into the back end of the week, things started to get a bit busier, certainly on the US side of things. Now, we started on Monday with a manufacturing PMI, which didn't really have much reaction to it, and negative manufacturing PMIs, but every single data release since the Fed's last meeting, bar this ISM manufacturing PMI up until today, had been positive and above consensus. So it kind of fueled fears of fueled thoughts of a soft landing in the US. But this week's data and last week's comments have kind of put paid to that sort of an idea. But we'll get on to that in a minute. We'll start with the RBA, the interest rate decision from the Reserve Bank of Australia. Consensus, as you can see, 4.35. We did not actually get that interest rate hike. No interest rate hike from the RBA, stating that they did need to see these or the effects of these interest rate hikes they've already done start to take effect on the economy. Now, the monthly CPI indicator that we saw last week did come back and pull back lower, back down to 5.6%, which is still too high. Inflation in Australia over the course of Q1 still at 7%, which the central bank did note was too high and is likely to remain too high for some time. They did not rule out further monetary policy tightening, but they did need to wait and see incoming economic data in order to make more of a decision. So they're on a hold at the minute, waiting to see what their interest rate hikes to date can do in order to cool down the inflation situation in the economy. Now we come over to the minutes then on Wednesday, where the minutes reiterated the hawkish stance and showed a unanimous decision, one, to hold interest rates, which is not a hawkish stance at their last meeting, but it was also a unanimous decision to suggest that they will need to hike interest rates again in the future. So no pause from the Fed, pause from a meeting, but no pause from the Fed in general. Markets are priced in an 85% chance of a 25 basis point hike. Fed Jerome Powell did not rule out a back-to-back interest rate hikes last week at the ECB's economic forum on central banking. So maybe that's to come, especially with some hot economic data over the course of the last month or 6 weeks, right? That brings us then into Thursday's price action, right? We click off this high impact data and we just come to the tier 2 data and have a look back at Thursday. We can see this ADP employment change, right? Consensus 228k jobs added to the private sector of the US economy. 497 is what we got, and we saw some massive downside off the back of that across stock indexes. Bit of upside across the dollar, which was not really replicated in the same way that the equity downside was. Then come into later on, and what fueled that fire was the ISM services PMI plus these job openings. Obviously, if there's less job openings than last month and less job openings than anticipated, means in this case more jobs are filled because of the amount of jobs added to the economy. That then brings us on to today's data. Canada, for starters, had a bit of a tick up in unemployment, but that was not centre stage today. What was centre stage was the non-farm payrolls report out of the US. Now, you can see NFP today, consensus was for 225, actual 209, so a slight miss on expectations, which is not what markets were expecting. Markets were expecting a beat on consensus. There was also a downward revision to last month's 339,000 jobs added, down to 306,000 jobs added to the US economy last month or the month before last, and then 209,000 jobs added last month, which brings the unemployment rate down in line with consensus to 3.6%. But now, another situation that the Fed have to think about in terms of interest rate hikes going forward. You can see these average hourly earnings, consensus of 0.3%, but an actual of 0.4 in terms of the yearly figures of average hourly earnings. Consensus 4.2 was for this to drop from 4.4, maintain that 4.4% number. Now, if more people are earning more money, right, if more people are earning more money, that continues that will mean people have more money to spend. People have more money to spend, most people will continue to spend, which will contribute to contribute to prices growth, will contribute to inflation as well. So that is another thing. If people's companies up people's wages in order to deal with inflation, that offsets the issue with inflation, and people can still continue to spend money like they have been in the past. So that is another thing the Fed need to think of when it comes to getting inflation under control, is that wage growth still continues to tick higher. Apart from that, then, if we jump over to the charts, you can see stock indexes. Now, across the US indices, you can see that over the course of Monday and Tuesday, low levels of liquidity. The S&P, the Dow Jones, the Nasdaq, and the Russell all held firm, but the DAX, the FTSE, and the Nikkei continued to push lower and have done. It's been a one-way train over the course of this week, which has got more aggressive into yesterday's price action, which we have obviously alluded to into yesterday. Now, that is due to ongoing rate increases. Markets had just not listened to this whatsoever for a number of months, stupidly, as I have said, but in terms of it being, that's what markets have suggested. The markets have predicted a pause from the Fed, which has not played out, and it's been a battle between, do you fight the markets or do you fight the Fed? Markets have fought the Fed for a prolonged period of time, and are they starting to wake up to the fact that the Fed are going to continue hiking interest rates? Inflation is not going away. Economic data remains strong, which means that the Fed can continue to hike interest rates. If economic data also, if that continues to be strong, that continues to put upward pressure on inflation. As long as economic data remains strong, there is upward pressure on inflation. That creates a situation where the Fed have to keep the foot on the gas, and that is negative for stocks. Right, so that is what we're looking at over the course of this week. Massive stock downside across the board. You can see that not really being replicated across the US dollar. You can see euro dollar pretty sideways, Aussie sideways, Kiwi sideways, dollar Swiss sideways. Cable has had a bit of upside, but really it's just sideways at the moment. Rate differentials in the UK, certainly UK interest rates from the Bank of England are likely to raise higher than other major central banks around the world. So some upside in sterling over the course of this week is not too hard to wrap your head around, and interest rates in the UK, as I said, likely to be higher than most of the other major economies. That is a situation where the Great British Pound or sterling should continue to push higher. Certainly in the short to medium term, the effect that these higher interest rates then have on the economy, probably likely to hike the economy into a recession. In order to cool down inflation, that is then a negative for all UK related assets. But we'll cross that bridge when it comes to it. For now, the fact that UK interest rates are going higher than the rest of the world, or certainly predicted to go higher than the rest of the world, is likely to prove supportive for sterling at the moment. Dollar yen continues to bounce off that 145 round number. Talks of intervention or fear of intervention kept it capped below 145. You'd imagine the initial move away was to do with some profit taking, but as sentiment has soured over the course of this week, this Japanese yen has strengthened. Plus, Chinese stocks, Asia Pacific stocks have been under more pressure over the course of certainly today and yesterday, due to the fact that the Chinese economy faltering. Chinese banks are struggling at the moment. They are down over double-digit percentages this week. Move away from Chinese stocks into the Japanese yen. Couple the fact that we're seeing European equities, US equities now sell off for a completely different reason, kind of gives a double support to the Japanese yen, which has pushed it a substantial amount away from that 145 number. And it's not going to continue at the pace that it is now, but as long as this negativity remains in markets, you'd have to imagine that Japanese yen continues to prove supportive, certainly over the short term. These 10-year yields have continued higher over the course of this week. Now, we seem to be rejecting off these highs in the 10-year. The 2 years have started to pull back. But the longer these continue higher, the more negative it is for stocks. Expectations for interest rates to rise in the future further than what markets had anticipated, as I said, continues to put pressure on stocks. One thing to note into next week, we did have this spike higher. Now, we did have the miss on NFP, which due to the beat on the ADP figures yesterday. You may have expected a miss on NFP to retrace these moves from yesterday, but we spiked up and we were sold straight back into. So some positive news for indices. Is it positive news for indices? I mean, the job market slowing is not technically positive for indices, but markets have taken it in the way over the last number of weeks, months, and even a couple of years. That bad data means the Fed turned more dovish, and then stocks then rally off the back of that. So the fact that we've seen some poor data today and it's been sold back into, I think is something we need to keep an eye on into next week. But obviously, when we get to next week, we will update further when we get around to it. But that's it from me then. Have a nice weekend. Keep an eye on those stock markets into the close and into next week, and we'll update further when we get to it. Thank you.